Hi, I'm Adam Burch, a senior client wealth strategist at Destiny Capital. And today I want to talk about what tax planning really is and how we help our clients keep more of the money that they've earned with several primary tax planning strategies. One thing we often see is that true proactive tax planning really isn't as common as you might expect, even in the financial advisory world. And that's understandable. Tax planning can feel intimidating, and the rules, of course, change over time and they change often. But that's exactly why we've made it such a core part of our planning process here at Destiny Capital, and it's something that we feel really passionate about. I do have to say that this video is for educational purposes only, and it isn't to be considered tax or legal advice. We know that every family's situation is unique and different, so before you make any significant tax decisions, please talk with your tax professional. With that said, most people are familiar with taxes really in one specific way: filing a tax return every single year. And of course, that's really important, but it's usually looking backward, and it answers questions like, what happened with our income? Did we file correctly? And did we pay all the taxes that we owe? Many people get help with investments and get help with filing their tax returns, but very few have someone in the middle connecting those two pieces together and looking ahead at how today's decisions affect their tax bill over the next several decades. And that's what tax planning is all about. It's more about helping structure your income, your savings, your portfolio withdrawals, and other decisions over many, many years so that you pay no more in taxes than you have to long term. Our role as advisors is to understand your entire financial picture and help design a plan that makes the tax rules work more in your favor. So instead of just asking, how do you pay the least in taxes this year or even over the next couple years, we want to ask, what strategies can we help you put in place now to smooth out taxes, avoid big spikes later, and keep more money over your lifetime? And one way we do this is by thinking about retirement and the typical retirement in phases. So many retirees have lower income years, especially early on, right after retirement. In the years before Social Security benefits have started, you've started drawing on your pension, and before you have to take money out of your retirement accounts. And then later, there are typically those higher income years where you've started Social Security and pension income, and you're required to take money out of the IRAs or 401ks, all at the same time. So good tax planning tries to use those lower income years wisely so that the higher income years don't unnecessarily push you into higher brackets. So let's talk about one of the key ideas we use, and that is filling lower tax brackets in lower income years. So imagine you've recently retired, you're living on some cash savings, maybe a small amount from your investments, but your income for the year is relatively low. And in those years, we may intentionally want to create some taxable income, and that might sound strange at first, but here's why we think about that. So if you're in a relatively low tax bracket this year, it can make sense to pull money into those lower brackets by taking withdrawals from your IRAs or doing a Roth conversion, for example, to fill up those lower brackets. You're choosing to incur income now at a lower rate to avoid paying potentially much higher taxes later when your income is forcing you into those higher tax brackets. And so that kind of bracket filling strategy can also help manage future Medicare surcharges and how much of your Social Security ends up being taxable over time. Another big part of tax planning is how your savings are positioned and what we call the three tax buckets. So first, there's the taxable bucket, and that would include things like your bank accounts or your brokerage account or regular investment accounts. And in those accounts, you pay taxes along the way on interest, dividends, and realized capital gains, but not usually on the bulk of the principal of the account. And then second, there's the tax deferred bucket. That would include things like traditional IRAs, 401ks, and other pre-tax accounts where you got a benefit when you put the money in, but you'll be taxed when you distribute from the accounts. And then third, there's the tax-free bucket. So that would include things like Roth IRAs, Roth 401ks, and in some cases an HSA if you use those for medical expenses. So that structure can be really great because having money spread across those three buckets gives you a lot of flexibility, especially in retirement. So when you are in retirement, we can help decide which bucket to tap into to create income while helping manage how much of that actually ends up being taxable. And that's one really important way we can help lower the tax bill over your lifetime. So let's go back to Roth conversions for just a second, because they're really a powerful tool if we use them in a really thoughtful way. A Roth conversion is when you take money out of a pre-tax account like an IRA or a 401k and you put it into a Roth account. So you're choosing to pay the taxes now instead of later. And so you might ask, why would you choose to pay taxes now? Because in return, you're getting the benefit of future tax-free growth and future tax-free withdrawals from that Roth account, which can reduce the size of the pre-tax account and avoid how much you have to take out of those accounts later. But the key to doing that is to do it really strategically and not just randomly. And that's where that bucket filling strategy comes back into play again. So we want to look at your current and future tax brackets and try to find windows where it makes sense to convert enough to take advantage of those lower rates. So that bracket optimization strategy doesn't really just apply, though, to retirement accounts. It also applies to taxable investments. In some cases, especially when your income is relatively low, it might make sense to realize some capital gains on purpose. And that might mean trimming some concentrated positions in the portfolio or cleaning up the portfolio while taking advantage of lower capital gains rates. And other times when your income might be high, which happens as well, maybe you have a significant one-time event like a business sale or a vacation home sale or rental property sale, and we want to help explore ways to reduce or spread out that tax liability over time. And that might include timing the sale, coordinating with other income items, or using losses maybe in the portfolio to offset some of those gains. And that's called tax loss harvesting, which is where we would sell securities at a loss to help offset any other capital gains. That's actually one item that our investment and client service teams review at the end of every single year to look for opportunities for our clients. And then the last major area that we focus on from a tax planning standpoint is helping you find ways to give to charitable organizations in a really tax efficient manner. And that might mean giving directly from an IRA to a charitable organization, or donating appreciated securities, or contributing to a donor advised fund in a really high income year. So when we say tax planning, here's what we really mean. We want to make sure that we're looking forward and not just backward. We want to help you use those lower income years intentionally instead of letting them go to waste. And we want to think through strategies, of course, to reduce taxes in the high income years, like I mentioned just a bit ago. We want to help build flexibility by spreading savings out across those three tax buckets. Look for strategies like Roth conversions or timing capital gains in a really intentional way. And then finally, looking for ways to make charitable giving as tax efficient as possible. So, and in many cases, we help clients implement several of those strategies all at the same time. The good news is if you don't have to become an expert to take advantage of those strategies. Our job as your advisor is to understand your entire financial picture, run the analysis behind the scenes, and then discuss opportunities with you in a really clear, actionable way. So if you're wondering whether you're making the most of your current tax situation or you're positioning yourself to optimize taxes long term, please reach out and schedule a call with our team. And if you have any friends or family, of course, who you think may benefit from this information, feel free to share this video with them. It might give them a good framework or a good place to start. Well, thank you for spending a few minutes with me today. And as always, if any questions come up, please don't hesitate to reach out to us.